with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, February 27th, 2026. Another month down here in 2026. Some shout outs to Chip, Tom, Sherry, Sabrina, Rob, Steve. Big shout out to Mike. Mike's always sharing our post out there on Facebook. So thanks for all the shares there, Mike. I see that. Appreciate it, bud. So what is going on with the markets this week? Well, they drifted lower once again. Dow Jones down 1.3% this week. S&P 500 down 0.4%. The NASDAQ Composite down 0.9%. The Russell Small Cap Index down 1.2%. And actually, a lot of that happened today. It was down 1.68% today. It took a big hit, and it's really based off of news that we got this morning, a piece of economic data regarding the Producer Price Index, the PPI. It came in hot, very hot, much hotter than expected, which indicates inflation at the wholesale level. And remember, folks, small caps like rates falling. They want to see short-term rates going down. And a hot inflation number would indicate that the Fed may not be cutting rates anytime soon, and small caps reacted accordingly. They didn't like that one bit. Look at the volatility index. It was up 4% this week, closing at 19.9 on the week. I think that can push higher. Here's the big surprise of the week. Long-term bonds as measured by the TLT up 1.5% this week. They are now up 4.2% this year. Bonds have been in the doghouse since the end of 2021, right? Just can't get out of their own way. And all of a sudden, they are coming to life. I have to tell you something, though. It's a little concerning. It smells like fear to me. Bonds are a safe haven. People run to long-term bonds when they're afraid of the market, and bonds are on the move. Now, the bright side of that is that when bonds go up, long-term rates go down. And not to take it too far into the weeds on that, but if you pay $1,000 for a bond, it's got $1,000 face value, paying 5%. You paid $1,000, the face value is $1,000. When it matures, you get $1,000 back. And that's paying 5% interest. Now, if bond values go higher, and that bond is now worth $1,500, just for argument's sake. All right, if you were to buy it today, you're paying $1,500. Well, when it matures, you only get $1,000 back. So instead of making 5%, now you're only making 2.5%. I know it's a little out there into the weeds, but the point is this. When bond values go higher, the yields go lower, and this is good for long-term interest rates. So mortgage rates hit another low this week that we haven't seen in a long time, a couple of years now. But I do think it smells like fear a little bit when it comes to what's happening there with the bonds. Take a look at some other things. When we look at the different sectors, did I say it smells like fear? Oh my gosh, it reeks of it. Utilities up 3% this week. Consumer staples up 2.4%. Energy up 1.9%, and healthcare up 2.1%. Oh my goodness. I mean, that just, wow, right? All defensive areas, that's where all the money went this week. And looking at the other areas of the market, semiconductors were down a couple percent, financials were down 2%, tech was down 1.5%, defensive areas getting the money, bonds getting the money, markets down. I just don't like the way that picture looks. Gold up 3% this week, and silver continues its roller coaster ride up 10.9% on the week. So continues just to be a really wild ride there for silver. All right, so what's moving markets? Well, there's a lot of noise this week. You had the State of the Union address on Tuesday night, a very long one. As I was watching that, I was also watching the futures. I really didn't see anything said that really moved the markets a whole heck of a lot. Nothing really new there that moved markets. In addition to that, you've had earnings continue to come out. I want to talk more about that in just a moment because the reactions to earnings haven't been what they should be. You've had U.S. and Iran tensions. They ease. They've picked back up again. There's questions now surrounding where those talks stand right now. It doesn't look like they're making a lot of progress. That could be a concern for the market. And then, of course, there's this overall AI story. And I'm going to put earnings and AI together here. There's a whole lot, actually, around the AI story. There's multiple prongs here that are causing problems. Maybe one of the big ones, and I don't even think we talked about it much last week, but private credit. What's private credit? Well, there's public credit. Those are bonds you buy. They're traded out on the market. There's tons of transparency. They're liquid. You've got all of the different data points and financial information, all the things you need to make a decision. And there's private credit, which is not publicly traded. You don't have the transparency. It's kind of off the books, if you will. There's no liquidity. If you buy it, you usually have to hold it for a certain period of time. And listen, private credit has been smoking hot place to invest in for 2, maybe 3 years now. It's been all the talk, all the rage. And if you've heard me speak about it or mention it, I've got nothing to do with it. I want nothing to do with it. I think it's a big black box that's going to hurt a lot of people. It has been such a fad. So many folks in our industry have been pushing our clients into this stuff. And I just think they're setting folks up to get hurt. We've stayed away from it. We don't have any private credit in any of our models. We haven't recommended it to anybody. And we've actually encouraged investors to stay away from it. Well, that whole space now is starting to crack, starting to unwind. We've seen some really big hits in private credit. And listen, a lot of that's attributed to and related to AI, data center buildouts, and all these things. There's a lot of money being borrowed off the books in these private credit markets, and there's some concerns there. That's one AI prong that is causing problems. Then there's another. There's a report came out this week that talked all about AI and how it's just going to decimate jobs and other companies and all these things. And man, so many stocks took a really big hit on this report. A big overreaction, in my opinion. I think that there's plenty of companies that are going to integrate AI and they're going to be just fine. I don't think AI is going to kill as many companies as the market is pricing in at the moment. But on the jobs front, I tell you, there's a cardinal rule in the industry. You never say it's different this time, okay? When stocks are at nosebleed levels, you don't say, well, it's different this time. They can go higher, right? When markets are getting hammered and they're down in the gutter and they look like a great value, you never say, well, it's different this time. You shouldn't buy because they're going to go to zero. So you just never take that mentality on anything when it comes to the economy or the market. It's different this time is a big no-no. So when you look at history and you look at these big expansions that we've had, the advent of oil, the advent of electricity, the Industrial Revolution, the technological revolution with computers and internet, these things have led to lots of job creation, tremendous amounts of job creation. Well, the big question right now is AI. And as much as I hate to say this, I've done a deep dive on this. I've tried to game this out. And I know I'm breaking the cardinal rule, but you know, it really does look different this time. I'm really having a hard time trying to envision and see where AI is going to be a major job creating mechanism. Maybe it will be, but I can understand the concerns. Reports are coming out, markets are responding to it, and I get it. Now, the other big thing related to AI has been earnings. Okay, NVIDIA reported this week, and they knocked the cover off the ball. I mean, they had a monster quarter. They beat in a big way. They raised their guidance. You would think that, wow, that would have been great for the market. The market would have taken off. No. As a matter of fact, NVIDIA ended up being down 6.6% on the week. It was down 3.8% today. It's actually broken down below its 50-day moving average. It's really close to its 200-day moving average. 200-day moving average on NVIDIA is 174 and change. It closed today at 177. Things don't look right here. Something is amiss. I can't fully put my finger on it. We don't own the stock in our models, but I went through the report. I listened to the conference call because I'm trying to figure out what is going on here. What am I missing? Because the stock's not that expensive. The numbers are fantastic, and the reaction is bad. Okay, I know there's a lot of circular financing deals that have been done where NVIDIA is giving money to company A and then company A is turning around and buying their chips from NVIDIA. I know there's some of that in the cards, but not enough to warrant such a poor reaction. And you know what? It's not new. NVIDIA's been dead in the water now for months. The whole market's been dead in the water for months. So when you put it all together, things are just not looking very good to me. I don't know if that's going to turn or if that's going to worsen. And honestly, it doesn't matter for us. We're sitting in a great position right now. We've really focused hard this year on loading up with things that are going to hopefully perform well in the face of a volatile or an ill-performing market. So things like our managed future strategy, right? That's one of our largest positions in most of our models. It's up 10.9% year to date. So that's doing fantastic. Our bond exposures, they're doing very well. Our energy exposures, I mean, look, Chevron's up 22%. Exxon's up 26%. Schlumberger Oil Drilling Services up 33.7%. That's all year to date. And that's been a big help. So right now, I don't know exactly how things are going to unfold moving forward. I would say that I think the market, if it breaks down below that 6750 level on the S&P 500, we probably have another significant leg lower. That could firm up. It could turn around. We're going to get some economic data next week. We're going to get a big jobs number next week. So all eyes will be on that. You've got Iran in the U.S. That's going to continue to unfold. So we'll be watching these things. But right now, I like where we are positioned. Our models have been performing well on the up days. They've been performing very well on the down days. So I don't think we need to do any major changes. We're just going to sit tight here and look for opportunities if the market provides them. Other than that, there's really not a whole lot to do. We've already done it. We've done a lot of trimming coming into this point in time. There's more trimming I would like to do, but we've got to wait till towards the end of March and into the middle of April to capture some of these long-term capital gains before we do that. So right now we just hold tight, let things play out. I like where things sit for us. Look, earnings have been strong. I think I mentioned that, but I looked at some analogs through history. When we've had earnings this strong in a stable economy, in a stable market like what we've been experiencing, the forward returns have not been that great. Now, again, there's not a whole lot of analogs for that, but nonetheless, I did finish my research on that, and forward returns didn't look that strong from that perspective either. So I'm not sure what the market's sniffing out. Economic data is not fully reflecting it at the moment, but I'm going to go ahead and just stick to our knitting and keep the diversification, keep the balance, and play the cards as they come out of the deck, as they say. So I'm going to go ahead and wrap up. Between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe just buy that beach house in the Caribbean, take that big trip, pay for that college education or that wedding. Good Lord, weddings are so expensive these days. Hey, you know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.